Imagine this scenario. A company just paid out a massive bill, and they based it entirely on a document clearly marked as a Proforma Invoice. They're feeling incredibly confident, right? They think they have all their paperwork perfectly in order, so the finance team goes ahead and claims literally millions of rupees in GST input tax credits. To them, it's just standard business. A bill comes in, you pay it, and you claim the tax back.
But wait, during a routine government audit, the tax authorities took one look at this and flat out rejected the claim. And worse, they didn't just reject it, they penalized the company heavily, finding them double the original amount for tax fraud. I mean, why did this happen? It wasn't some malicious mastermind scheme. It was simply because the finance team tried to claim real, legally binding tax credits using what is, effectively, just a dummy document.
Okay, let's dive into this. A Proforma Invoice is exactly that, a dummy document. It's strictly a draft bill, or really just a formal quote to let you know what the final cost of a transaction is going to be. It lets you prepare your internal budgets, but here is the absolute critical part that teams forget all the time. It carries zero legal or tax weight. Zero. It's essentially a promise of a future transaction, not a finalized event.
Now, the dynamic completely changes when we talk about an actual tax invoice. This is the official, legally binding document. It officially records the sale, it outlines the exact tax charged, and it actively demands your cash. This right here is the crucial piece of paper that actually moves a transaction from just a proposal or an estimate into a real, legal financial obligation that both you and the government recognize.
And you know, in today's digital compliance landscape, we've evolved even further to the e-Invoice. What is this? Well, it's a tax invoice that's been digitally registered directly on the government's tax portal. When that registration happens, the government stamps the invoice with a highly unique 64-character invoice reference number, we call this the IRN, along with a scannable QR code. This specific security measure absolutely guarantees the invoice isn't a fake. It proves it's been formally recognized by the state.
And this brilliantly illustrates the whole concept. Think about dining at a really nice restaurant. The Proforma Invoice, that's essentially the menu. It tells you exactly what that steak is going to cost before you order it, so you can plan your budget for the evening. The tax invoice is the physical receipt the waiter hands you at the end of the meal, actively demanding your payment. And the e-Invoice, that's the equivalent of the restaurant immediately transmitting that exact receipt directly to the government tax department the very second it's printed. It makes sure no one can secretly alter those numbers later to dodge taxes.
Let's move to and see how this builds chronologically for a corporate buyer, let's call them XYZ Limited. Imagine Ria wants to buy some highly specialized custom machinery and the vendor wants a 30% advance payment up front. Since the machine isn't actually built yet, the vendor can't legally issue a tax invoice, so they send a pro forma instead. This gives Ria's team the internal paperwork they need to process that advance cash. Fast forward 3 months, the machine is finally delivered and the official tax invoice is issued. Because this is a massive corporate vendor, they are legally required to generate an e-Invoice. So before Ria's team pays that final balance, they meticulously scan the QR code on the bill to verify the government IRN, just making absolutely sure everything is legit.
So this brings us to a really critical misconception, and it catches a surprising number of teams off guard. Look at this breakdown. The big myth here is the belief that holding any piece of paper with a GST amount written on it automatically entitles you to a tax refund. Not true. The reality is far stricter. A pro forma does not create a tax liability. Sure, it might have a tax amount calculated on it for estimating purposes, but you can only legally claim your input tax credit if you hold a valid, finalized tax invoice. Submitting literally anything else is a major compliance failure.
Now, what's really interesting about this slide is when you look at this entire process from an auditor's perspective. The absolute ultimate red flag, it's the missing IRN. Auditors rigorously scan accounts payable data, specifically hunting for high-value tax invoices from large vendors that lack a government QR code or IRN. If they spot a massive invoice that should be digitally registered but isn't, well, they know immediately that the company is exposed to immense financial risk.
And the consequences of missing this crucial detail are incredibly severe. Listen, if a vendor is legally required to issue an e-Invoice, but an accounts payable clerk just accepts and pays a standard unregistered paper invoice instead, your company permanently loses the right to claim that GST credit. It is gone forever, sinking straight to your bottom line. To prevent this catastrophic loss, diligent auditors will strictly lock the ERP system. They configure it to automatically reject any large invoice that fails that IRN verification. So, Always ensure you are trusting the correct paper trail. It's really easy to get lost in a sea of documents, but knowing the difference can literally save your company millions. Take a close look at your own operations and ask yourself, are you paying dummy documents or are you actually securing your tax credits? Keep that in mind, stay vigilant, and we'll dive into the next layer of this in Explainer 24B.